Okay, hi everyone. This is going to be the first lecture for Chapter 4. We're going to be talking about IFRS here. So, as we've discussed in prior lectures, right, the IASB makes IFRS. It's kind of like the FASB makes GAAP. And with regard to IFRS, it's the most widely used accounting framework in the world. It's kind of like, and I've mentioned this before, how we use the US measurement system, where the rest of the world uses the metric system, right? And when we're talking about IFRS, we're really saying in this regard the promulgations, that is to say, the actual IFRS that has been made by the IASB, and then formerly the ISAs, which have been made by the IASC. But if you remember correctly, right, the IASC ultimately became the IASB. So when we refer to IFRS, it's kind of a conglomerate of prior and current standards. Now, U.S. domestic companies, they traditionally use and are required to use U.S. GAAP for the U.S. equity markets. However, with the globalism and other items, the world becoming bigger, foreign companies on U.S. equity markets can use IFRS instead of GAAP. So, for example, you could have a German company that uses IFRS. If they meet certain requirements, they would be allowed to be listed on the U.S. equity markets. Now, this chapter, right, we're going to be looking at kind of the similarities and differences between U.S. GAAP and IFRS. And in this regard, right, we're going to be looking at different areas such as definition, right? How do they define terms, right? How is an asset defined? How is a liability defined? How are certain accounts defined? As well as how do we define recognition, measurement? With regard to recognition, right, this tells us when do we recognize or book, make a transaction for an event, right? In other words, when do we debit expense? When do we credit revenue? When do we book the purchase of a fixed asset, right? What criteria gives rise to these? Then we'll say the next idea here is measurement. We know we need to recognize a certain item, but for how much, right? If we were to quantify what number we put next to debit expense, right? $100, $1,000. How do we measure what's going to be on there? And with regard to recognition and measurement, what choices or alternatives do we get? In other words, can we value PP&E, right? IFRS allows it at historical cost or current fair value. You have two different choices there. GAAP generally says, no, you have to use historical cost. Guidance, this is another area, right? IFRS tends to be more focused on professional judgment, whereas US GAAP tends to be more rules-based. So the amount, the type, and the nature of the guidance may differ between the two frameworks. Presentation, this is another area, right? Like we have these financial statements. How do we present them? In what type of order? We've seen this in prior chapters, right? It can be cosmetic items, such as names or titles of forms. It can be the ordering of forms. And then finally here, disclosure, right? With regard to footnotes, how much of them are we required to make? What do we need to put in the financial statements themselves versus maybe we can bury in a footnote? So the nature, quality, and quantity of disclosures with regard to the financial statements. All of these items we'll look at least in an initial sense, for how they're set up in IFRS versus how they're set up in GAAP. Now, as I've indicated, right, IFRS tends to be more flexible than US GAAP. It's really based on professional judgment. And a lot of the standards may have rules or sentences or clauses that lead room to interpretation. And they will let the practitioner rely on their professional judgment to determine what that means. In distinction, right, US GAAP tends to be much more rules-based. They may have a provision, right, you need to record PP&E at X, but then they would have a subset of rules that would maybe show tons of examples, scenarios, situations for how you apply that provision. So it would be a much more detailed analysis with regard to guidance and rules. So as I've indicated and as I have on here, right, another area is disclosures, which we'll talk about. How do we disclose these? So if we were to look at specific types of accounts or areas of the financial statement, let's start with inventory, right? So under IFRS, when you have the cost of inventory, right, what you debit inventory for when you purchase it, it's generally going to be things like what it costs, taxes, transportation, handling, really everything up until that point in time when the product is delivered to the company, right? It's in working condition, it's present, it's here, all of those costs. Things that aren't included in inventory, so things that you would probably expense, right? This would be like waste, spoilage, labor. Storage costs, right? You have to store the inventory. That would be an expense under IFRS. You don't capitalize it. Certain administrative manufacturing overhead as well as selling cost. All of these items aren't included in inventory. Now, with regard to inventory frameworks, right, there's a few different ones here. And IFRS, for example, they allow FIFO, weighted average, and specific ID. They do not allow under IFRS LIFO, right? And one of the items they have here is the same inventory method must be used for all similar nature inventories, even if they're located in different geographic jurisdictions. So if you were to use FIFO on all of your, inventory X in one country, then you have to use it for everywhere that's inventory X, right? It's, you use it for one, you have to use it for all the other similar types of inventory. Now, GAAP in distinction, they allow for LIFO. You can use LIFO in GAAP. And one of the things they don't require is that similar inventory method used for all of the same or similar types of inventory. So inventory X, may use LIFO. Another inventory that's very similar may use FIFO. They don't have that kind of strict uniform requirement. With regard to valuing inventory on the balance sheet, both US GAAP and IFRS, they're going to have it be put on there at the lower of cost or NRV, net realizable value. Basically, what you can sell it for minus its selling costs, what you net. However, if you write it down, right, you take it down, the lower of the two, you lower the cost of the inventory, only IFRS is going to let you write it back up. In other words, that's not going to be allowed in US GAAP. So if we look here, right, this is just showing an example. In this case, it's saying, hey, the lower of cost, $1,000 or NRV, being 830 is going to be 830, right? It's showing that right up there. So under both IFRS and US GAAP, you would value the inventory at the lower. So if it's at 1,000, you want to take it down to 830. You have to hit a loss and a credit for your inventory to take it down to that amount. Now, let's say instead in year 2, this inventory has gone up to 980, right? So it's gone from 830 to 980. In this case, you would be able to uptick the inventory, ratchet it back up to the greater of the two. In other words, under IFRS only, you could revalue the inventory back up. So both let you take it down, but only IFRS lets you take it back up. Next, let's look at PP&E here, right? So PP&E, I always say accounting had it first, right? So when you think of PP&E, you may think of like medical equipment and supplies, right? Protection items for medical workers. However, in accounting, right, we had it first. It was always been property, plant, and equipment. Now, the main difference between IFRS and US GAAP is going to be basically how you value it, right? Under IFRS, you can pick between historical cost, or you can use fair value, kind of a modified revaluation with fair value. In distinction, right, GAAP, you just pick historical cost. So generally, IFRS is going to be required when you first buy it. It's going to be on there at cost, right? That's going to include the purchase price, taxes, costs already, and then the present value of the future costs to dispose of the item. So originally, right, under both, you put it in at cost. Later on is where you kind of get the choice in IFRS. Now showing this, right, it looks like we buy a building and machine. State law requires that at the end of their useful life, we have to disassemble them. So with that, right, we're going to look at how much it costs us to build each one, plus the present value. So we're going to shrink down the future costs of dismantling and removing it to what those and what that amount would be in today's dollars. It's going to give you 1,059 here, 2,014,000 down here for respectively the building and the machinery and equipment. So debit building 1,059, debit M&E 2,014,000, right? We then would have a provision for the removal. It would be $74,000, namely the combination of the 59 and the 14. And in total, right, the out the door number in this case would be 3 million. So you can see how we populated it there. Now, after purchase, right, this is where the distinction between IFRS and GAAP comes in. So IFRS says, hey, after purchase, you have it on there using the framework we just indicated. You can keep PP&E either at historical cost, which is really just net book value, what you bought it for minus accumulated depreciation, or kind of a modified net book value using future value. That is to say, or I'm sorry, meaning with fair value, where you would have fair value minus any subsequent accumulated depreciation minus impairment losses. So one of the things with PP&E under IFRS, if you do choose that revalue option, we'll look at an example which will give some numbers to this. If you use it on a certain class of assets, then you have to use it on all of those classes of assets at the same time. So for example, if you were to revalue a machine, you would have to revalue all machines. You can't kind of just like cherry pick which one you want. If when you're revaluating it, the fair market value is greater than the carrying value, in this case, that excess amount is going to be a revaluation surplus. And generally, that's going to become part of other comprehensive income. Whereas in distinction, if you have the reverse setup, the fair value is less than the carrying value, namely you'll be at a loss on it, then you're going to expense that. It's going to be the general framework there. So it ticks up in value, hit OCI. It goes down, expense it. And with presentation, you can put it at the gross amount minus accumulated depreciation. So like, I don't know, 1,000 minus 70 or something, right? That would give you 930. Or you could just put it on there for the net amount, the 930. And similarly here, right, you can recognize any revaluation surplus, you know, what's been in OCI as part of normal income, net income on the income statement when you dispose of the asset. So here is where kind of the math gets a little bit tricky on this revaluation, right? So we set it a general rule with regard to IFRS. You initially put it on there at cost. Afterwards, you kind of get to pick what you want to do. You can keep it on there at cost, or you can revalue it using fair value. Now, when you revalue it, fair value is basically, you know, what is this worth? And you would look at what an arm's length transaction would be. Right? What would this PP&E, whatever the item is, what would this sell for on the open market? Sometimes this is easier to establish than others. It's really a function of what the specific item is. Regardless, right, this is where things get a little tricky and you have to look at it here. In a revaluation, we need to keep the relative proportions of cost to accumulated depreciation. However, it should net out to that fair value amount. Let's look at an example to illustrate this. So let's say we have a building that we bought originally for $1 million. Since then, we've taken 600 grand of depreciation. Right now, we're going to be at a $400,000 carrying value. Simple enough to start there, right? Let's say at this point in time, we say, hey, we want to instead revalue this at fair value. In other words, we want to depart from historical cost. Now, what you don't do in this case is you don't just put it on there for 750. You kind of ultimately do arrive at that, but you have to, in arriving to that, maintain the relative proportions of cost to accumulated depreciation. So here's where we are, here's where we want to be. Now, if you look at it over here, it's showing us, right, our proportions here are our original cost, $1 million. We're going to have 60% AD, 40% carrying value. So if we want to ultimately land here at 750 at our carrying value, we have to maintain those proportions of 40%, 60%, and 100. So in this case, right, if you're going to revalue it to fair value, you would have the carrying amount go up to 1875, and you would have the accumulated depreciation go up to 1125. This will get you ultimately right to 750 where you want to be, because that's what you want to revalue it at. But you have to keep the proportions of cost to accumulated depreciation the same. So this is just showing you here a couple different scenarios from year 1 to year 2. You can look at that. Now, under IFRS, the choice of historical cost versus revaluation method, this can produce different outcomes on the financial statement. So we've said here that the idea with this is if you have a positive revaluation, you're going to hit OCI for that, other comprehensive income. So in this case, right, in this specific scenario, you may be at an overall loss on the income statement, but when you factor in your OCI, right, the positive from the revaluation of the land and buildings, your PP&E, it's ultimately going to throw you into a positive position. So this is really just saying that, hey, when you revalue it, you got to hit OCI for that amount with regard to PP&E. So similar to US GAAP, IFRS depreciation is going to have an estimated useful life and residual value. There will be different depreciation methods, straight line, double declining balance that you can choose from. They also maintain something called component depreciation. So this would be like maybe if you bought an airplane, right? Instead of depreciating the whole entire airplane, you may break it out into different pieces. Like maybe you depreciate the engine as one item. Maybe you depreciate the seats as one item, the wings as one item. So instead of one item being depreciated, you break that item into multiple items and individually depreciate those items. So that's called component depreciation. Finally, I have here gain or loss should be recognized upon disposition of PP&E, a derecognition event. One kind of sub-twist on this is the idea of investment property. So there's this IAS 40 that deals with that. So investment property, as they define it, would basically be land or buildings that you hold for rent or capital appreciation. So maybe I buy this plot of land for $100,000, and I think that they're going to be building houses in this area, and there's going to be an in-demand influx of people here, so I'm speculatively buying this for it to go up in value, capital appreciation. Under US GAAP, what you would do in this case is you would basically just keep it at historical cost. However, under IFRS, right, you would have, again, that same option of historical cost, but you could also use fair value. Where it differs, right, because you may say, hey, we've already said that, that's true. Where investment property differs is basically the revaluation gains or losses. So in that case, under IFRS, first off, I guess the framework would be something like this. I'm using IFRS. I can use either historical cost or fair value. If I use fair value, right, it depends on what type of PP&E I'm using it for. If it's traditional PP&E, any revaluation gains or losses are going to hit OCI. If, however, the item in question is considered, as it were, investment property, then the gains or losses are going to hit the income statement, right? So that's like kind of the first difference between these. It's a minor difference, but it's going to hit a different part of the item there. It's going to be part of net income. So the second idea with investment property is that because we're periodically updating it to fair value, IFRS is going to eliminate any depreciation on investment property. So this is just showing you, right? You have the income statement. An increase in fair value, if you were using that model, would hit the income statement right there. It wouldn't go in OCI. It would be part of, instead, net income. Next, biological assets, right? These are things like forests, so on and so forth. GAAP's going to say, hey, you have to keep these at historical cost, right? But one part that this kind of misses, if you think about it, some of these biological assets can actually get bigger over time. So if you have a forest, right, maybe it like literally gets bigger. So IFRS, in recognition of this fact, kind of provides a different framework. They say that biological assets should be kept at fair value. And in this case, revaluation gains or losses are going to go on the income statement. So that's, again, similar to that investment property. Use it at fair value when you do have the revaluation gain or loss on the income statement. This is just showing an example of that, types of biological assets. Here's the income statement. The increase or decrease would go and affect net income. Impairment of assets, right? So the idea here is both US GAAP and IFRS are going to test for impairment. Under IFRS, impairment testing and losses can be used for PP&E, intangibles, goodwill, and investments in subsidiaries. Impairment testing does not apply to things like inventory, CIP, DTAs, AR, and NR. Now, one idea here with IAS or under the IFRS is that entities have to annually assess whether there's indicators of asset impairment. If these exist, right, we're assessing it annually. We say, hey, we think there's indicators of impairment. At that point in time, we say, what is the recoverable amount of this item in question, and we would compare it to the carrying value. So if we're looking at it here, US GAAP, again, test for impairment. What they say is, hey, impairment exists when the carrying value is greater than the undiscounted future cash flows. In distinction, IFRS says, hey, impairment exists when the carrying value, after we find that there's indicators of asset impairment, the carrying value would exceed the recoverable amount. Now, the recoverable amount is defined as being the greater of the net selling price, so what you could sell it for minus any selling costs, or its value in use, which is basically the future cash flows of the asset, but they're discounted, shrunk down to what they're worth today. So here's showing the distinction between the two. GAAP, we have impairment on an asset when the carrying value is greater than the undiscounted future cash flows from continued use of the asset. So that basically says, what do we expect the future cash flows from this to be? Maybe we get $100 this year, $200 next year, $300 next year. Add them all up, that's undiscounted. IFRS in distinction says, we have impairment when the carrying value is greater than the recoverable amount. Now, when we're talking about the recoverable amount, that's going to be the greater of generally what we can sell it for or the discounted future cash flows. So the idea here would be it's similar to up here, right here, except it's discounted. We're going to shrink these down to what they're worth today. So that's the idea with it, right? They're similar in setup when determining if there's impairment, right? So now that we've established that first question, right, like is there impairment? The second question would be, how do we measure the impairment, right? For how much are we going to take impairment, have a loss? How do we quantify this? So GAAP, we looked at it. We said, is this greater than that? Move to step 2. When we're valuing and measuring impairment, we're going to say our impairment loss is the carrying value less the fair value. So if we have 100 carrying value and a 60 fair value, we're going to have an impairment loss of 40. So it's step 1. If this is true, move to step 2 to quantify it. For IFRS, similar framework. Step 1, does impairment exist? Is the carrying value greater than the recoverable amount? If so, move to step 2. In this case, the impairment loss, how we were to quantify it, would be the carrying value less the recoverable amount. So if we had 100 carrying value and a $75 recoverable amount, in that case, we would have an impairment loss of $25. So this right here is just showing an example of how you might do it under US GAAP and IFRS for determining the amount, whether there's impairment, and if there is, how we would quantify it. You can look at this. And then finally here, we'll stop after a few more slides once we get done with impairment of assets. Another thing to be aware of is that US GAAP doesn't allow reversal of previously recognized impairment losses. So if you take an impairment loss, you go to step 2 under US GAAP, it's like a permanent write-down. You can't write it back up. However, IFRS says, yes, we are going to allow for reversals of previously recognized impairment losses. That is to say, if after we recognize the loss, the recoverable amount exceeds the new carrying value, then the impairment loss should be reversed and recognized in income. However, kind of the caveat to this is we're only allowed to do this, only permitted to do this, if there's changes in estimates used to determine the original impairment loss, or we change the basis for the recoverable amount. In other words, if we go back here, we said the recoverable amount would be, one of these two. If we originally did it using maybe value in use, and then we change the basis to net selling price, or vice versa, right? That's what they're talking about when they say here, change between net selling price and value in use. In these cases, the companies would increase the value of the asset, but only up to what they currently would have been, but for the previous impairment loss. So let's look at an example here, and we'll finish up this part of the lecture with it. So let's say here we have an asset that costs $1 million, and there was $25K in annual depreciation. You can see that, how we buy it, then we depreciate it. It says at the end of year 3, we have $185,000 impairment loss. So in this case, right, our $925 carrying value is going to exceed our recoverable amount. Okay, we hit the impairment loss, $185,000. Next, we say, here we are in year 4 and year 5. We're going to take $20K of depreciation each year on the item. So $20K, $20K. We're going to shrink this down from $740 to $700, right? So here we are at the end of year 6 at a $700,000 carrying value, right? Bought it, take an impairment loss, depreciate it. Here's where we stand. So that's where we stand, right? Just, showing us here. So that should be, year 5. Not a big deal there, just cosmetic. In any event, right, we're here at $700K at year 5. A new discovery shows that the recoverable amount is now going to be $900,000. In other words, we're changing our, from NSP to value in use. So in this case, right, we used net selling price. Now we're changing to value in use. Because we're doing that, we meet the criteria, right? We're down here. So we're permitted to take the reversal on any prior impairment losses. So If we look at it, but for the impairment loss in year 3, the carrying value of the asset at the end of year 5 would have been 875 grand. In other words, we would have just continued to depreciate it by 25 grand every year. So imagine we never took the impairment loss, right? We bought it for $1 million, every year depreciating it by 25,000, right? Had we done that, we had never taken the impairment loss, our carrying value right now would have been 875. Thus, if we're going to reverse the impairment, we can only do it for $175,000. That is to say, we can only take it from 700, where we are, up to where we would have been, but for the impairment loss, taking the actual loss for it. It's a little bit tricky. I think if you were to watch this and maybe 2 or 3 times or look at the slides, you could see that shake out. So with that, we're going to finish here with lecture 1. And we'll see you in lecture 2.